Housing has been front and center this summer as prices continue to soar.
Canada's housing crisis.
Canada's housing crisis.
Canada's housing crisis.
Terrible news today. The average mortgage payment in Canada has now risen to $3,500. This is the fastest increase in mortgage payment costs in the history of Canada, and by far.
What can we do about it? At the end of the day, everyone needs a place to live in. And when it comes to housing, you really only have two choices. You either buy or rent. Today, we're going to dig deeper into the buying option. We're going to figure out important metrics to try and time the market to get the best deal possible. And if you stick all the way to the end of this video, I'll show you my secret on how I plan to save up for my first property. When doing my research on the housing market, I noticed some keywords constantly reappearing. Interest rate, inflation, housing starts, economy, immigration. These keywords were everywhere. So let's find out how these terms are related and how we can use this information to our advantage. You don't have to be a genius to understand the correlation between interest rates and home prices. Typically, if the interest rate is high, mortgage payments go up and less people can afford buying a house, so house prices go down. And if interest rates are low, that means more people can afford buying houses, and if more people can afford buying houses, this could lead to bidding wars, which ultimately is going to increase the prices of homes. But if interest rates are so important in the housing market, then what metric can we use to predict these interest rates?
Inflation.
The Bank of Canada aims to cap inflation at 2% per year. And just so you have an idea, inflation was at an all-time high of 6.8% in 2022. This basically means that the cost of living increases and it becomes much harder for you to buy your everyday items at a reasonable price. To keep inflation at 2%, the Bank of Canada adjusts its key policy interest rate. When inflation is higher than 2%, they raise this policy rate, which increases the interest rates on deposits, loans, and more importantly, on mortgages. The idea is that higher interest rates encourage saving and discourage borrowing, which reduces people's spending power. As a result, companies try to keep their prices steady or even lower them to stay competitive and to ensure that they have sufficient demand. And if companies don't increase the prices of everyday items, then this helps bring inflation down. All this to say that interest rates are related to inflation. If inflation is up, then your interest rates are also going to go up. And if inflation is at a steady 2%, then the interest rates are going to go down. Nice. So now we know that house prices are affected by interest rates, which are dependent on inflation. But what other factors can affect these house prices? The classic supply and demand. Supply in this case would be the number of houses up for sale, and demand would be the number of people trying to buy a house. It's no secret that there's a housing shortage in Canada, but is this likely to change anytime soon? To figure this out, we need to check for predicted housing starts in the next couple of years. According to the Canadian Housing and Mortgage Corporation, we expect housing starts to see a significant decline in 2023 due to constraints in new construction. This is partially due to labor shortages, elevated costs of material, and high financing costs. Looking at the numbers, the forecasted housing starts for 2023, 2024, and 2025 are all predicted to be lower than the previous 2 years. Now let's discuss demand. According to Google, the average age of a first-time homebuyer is 33 years old. And if we check Statistics Canada, we can see that the number of people between 30 and 34 years old is steadily rising every year. To add to that, Canada is a country built through immigration, and it aims to welcome 447,000 people in 2023 and 451,000 people in 2024, which represents 1% of the total population. So if the population steadily increases year over year, but new construction actually slows down relative to the previous years, then it should come to no surprise that we expect house prices to continue to increase for the next couple of years, regardless of the interest rates. But if you're not fully convinced yet, let's check out the CHMC house price predictions for the next couple of years. According to the CHMC, the average home price is expected to increase in 2024 and 2025 relative to 2023. On a positive note, since 2022, inflation has steadily decreased from its high of 6.8% to 2.8%, which is a good sign for borrowers. But keep in mind that going from 2.8% to 2% is still an uphill battle. Also, just as a side note, I'd like to mention that the real estate market is heavily location dependent. So if you're seriously considering buying a home in the near future, I'd recommend that you check out the CHMC predictions for your local area. I left a link in the description where you can download a PDF and learn more about the real estate forecast in your local region. Now that we have a better understanding of the factors that affect the real estate prices and came to the conclusion that the prices are not going down anytime soon, the only actionable steps we can do is save up for our down payment. And luckily for you, the Canadian government just introduced the FHSA, which stands for First Home Savings Account. This new registered investment plan was introduced in April of 2023 with the intention of helping first-time homebuyers save up for their first property. The FHSA combines the benefits of the TFSA and the RRSP all in one package. On one hand, you get to grow your money tax-free, just like in the TFSA, and on the other, you get to claim your contributions as a tax deduction, just like an RRSP. So by contributing to the FHSA, you actually reduce the amount of money that you have to pay in taxes by the end of the year. To qualify for a FHSA, you have to be over 18 and have not lived in a residence that you, your spouse, or your common law partner owned in the past 4 years. Once you have your FHSA open, you can invest in assets tax-free for up to 15 years, after which you have to close your account. And when you decide to withdraw your money from your FHSA, this money must go towards your first home, and this home has to be your principal residence. And just like any other registered account, there are contribution limits for the FHSA. You're allowed to contribute up to $8,000 per year and up to a lifetime total of $40,000. Also, you can carry forward your unused contribution space from the previous year to use it in the next year, up to a maximum contribution addition of $8,000. So if you're planning on buying a property in Canada within the next 15 years, then it would make sense to open an FHSA to start saving for your first property. That way you can benefit from tax-free growth and minimize the amount of money that you spend in taxes by claiming your contributions as tax deductions. And that's it for today. If you enjoyed this video, make sure to check out my other video where I explain how you can go from $10,000 to $1.4 million through compounding. Don't forget to like, comment, and subscribe for more.